Welcome, everyone. We're diving into some documents you've shared today, specifically excerpts from ABC Revised Insurance Contracts.
That's right. Looking at IFRS accounting standards for insurance contracts and also how US GAAP lines up or sometimes doesn't.
Exactly. So our mission here is to pull out the really key stuff, the essentials from these standards to give you a clear picture without, drowning in all the technical details.
It's about understanding how insurers account for their promises, fundamentally, how these contracts hit their books.
So the big question is, what are the core ideas behind how insurance contracts are treated in these frameworks? And why does it actually matter?
Well, let's jump in. The absolute foundation, mentioned right away in the materials for both IFRS and US GAAP, is this idea of transferring significant insurance risk.
Right, that's the whole point of insurance, isn't it? You pay someone to take on the financial hit if something bad happens.
Precisely. And when they first recognize these contracts, both standards look at grouping them.
Grouping them. How so?
If they're managed together and, profitability is looked at for the whole group, like a portfolio of car insurance policies, maybe.
Okay, makes sense. And the documents mention some key moments for recognition.
Yeah, things like when the coverage actually starts or when that first payment is due. Also, crucially, if a group of contracts looks like it's going to lose money, becomes onerous.
Now, here's something interesting to mention. IFRS has this general measurement model, the GMM. The notes say it has some similarities to US GAAP aspects.
Yes, the GMM is sort of the default under IFRS for valuing these insurance liabilities.
Default model. What's the core idea?
It's forward-looking. It focuses on the expected future cash flows from the contracts.
Okay, future cash flows.
But adjusted. Adjusted for the time value of money discounting and, importantly, something called a risk adjustment.
A risk adjustment. Tell me more about that.
IFRS explicitly requires this. It's meant to reflect the compensation the insurer needs for, well, bearing the uncertainty about the timing and amount of those future payouts.
So it's pricing in the risk explicitly.
Yeah, exactly. But I should add, the documents also mention IFRS isn't only the GMM. There are alternatives.
Alternatives? Like what?
Things like the premium allocation approach, PAA, or variable fee approach, VFA. These might be used for certain types of contracts, maybe ones where policyholders participate in profits.
So there's some flexibility even within IFRS, depending on the contract.
Right. Different contracts, potentially different models.
Okay. And how does US GAAP handle this initial recognition and scope? Is there a default model there too?
Well, under US GAAP, the main guidance is in the financial services insurance codification topic. It applies broadly to insurance and reinsurance companies.
Got it. But no single default measurement model like the IFRS GMM.
That's a key difference highlighted. US GAAP doesn't really have that single default. The specific valuation method used really hangs on the specific terms of the contract itself.
So more contract-by-contract determination under US GAAP.
Generally, yes. And the rules also cover entities that aren't pure insurers, but still take on significant insurance risk. They fall under specific parts of the codification, too.
Okay, let's dig into the measurement side more, the liabilities. This term insurance risk keeps coming up. What's the specific definition we're working with here?
Good question. The definition provided is essentially the risk that the insurer has to pay out significantly more than expected because some uncertain future event covered by the policy actually happens.
But the key word there seems to be significantly.
Absolutely.
Yeah.
The documents really emphasize distinguishing significant insurance risk from just, say, financial risk like changes in interest rates or market prices.
And why is that distinction so critical?
Because under IFRS, for a contract to even be an insurance contract for accounting purposes, it must transfer significant insurance risk.
I see. If it only transfers financial risk.
Then it might be treated as a financial instrument, which has totally different accounting rules. It's a fundamental classification issue.
That makes sense. Risk type dictates the accounting path. Now, what about when these contracts end? Derecognition, they call it. How does that work?
Under IFRS, it's typically when the contract is extinguished, all obligations met, or if the terms are changed so much, it's effectively a new contract.
So fulfilled or fundamentally changed. What about US GAAP?
US GAAP often ties derecognition to specific events. The documents mention things like a business combination, one insurer buying another, or a portfolio transfer.
A bit more event-driven, perhaps?
You could say that. And interestingly, when an insurer acquires contracts in a business combination under US GAAP, They measure those newly acquired liabilities based on their own existing accounting policies at that time.
Okay, that's an interesting detail. And where do we actually see these liabilities on the balance sheet? And what about reinsurance?
Both standards require a separate presentation. Insurance contract liabilities are shown distinctly. Same for reinsurance assets.
Reinsurance asset.
Yes. Under US GAAP, for instance, the company that bought reinsurance, the ceding entity, reports the present value of what they expect to get back from the reinsurer as an asset.
Right, the recovery they expect. It sounds like showing things clearly is a major focus. The documents talk about extensive disclosures.
Oh, definitely. Transparency is key. Both IFRS and US GAAP demand a lot of disclosure.
Why so much detail?
It's crucial for investors, regulators, anyone trying to understand the insurer's financial health. The disclosures aim to show the impact of these contracts on the company's financial position and, importantly, its cash flows.
Are the requirements similar?
Broadly, yes, but the documents note US GAAP often requires even more detail, especially for short-duration contracts and for companies registered with the SEC.
More granular under US GAAP then.
It seems so. The goal is to give users a really clear view of the expected cash flows, the assumptions behind the numbers, and, the inherent uncertainties.
Okay. Now, are there things that look like insurance but aren't covered by these specific standards? Any exclusions?
Yes, several. Both frameworks exclude certain things. A common one mentioned is warranties from a manufacturer or retailer.
Like the warranty on my toaster.
Exactly.
Yeah.
That usually falls under different rules like revenue recognition or specific warranty accounting.
What else is excluded?
The list includes things like employer assets and liabilities from employee benefit plans, certain rights tied to using non-financial items, residual value guarantees, most financial guarantees, and fixed-fee service contracts.
So contracts where the primary risk isn't that classic insurance risk.
Generally, yes, they have different characteristics.
The documents also mention long-duration contracts specifically under US GAAP. What are those?
Think life insurance. Whole life, universal life, term life, endowments, participating policies.
Contracts designed to last a long time.
Right. Their terms aren't fixed for just a short period. And the material notes, they often aren't subject to the same kinds of policyholder mortality or morbidity risks in the way that, say, a short-term health policy might directly compensate the holder for illness.
How does IFRS handle similar contracts or exclusions? Any optional treatments?
IFRS also has exclusions, yes. And the documents point out optional exemptions sometimes, especially if separating the insurance part from an investment part within a contract is really difficult or not very meaningful.
Ah, so a bit of pragmatism there, perhaps.
It suggests that, yes, allowing an exemption when this separation is messy.
This talk of different components brings us to embedded derivatives. What are those in an insurance context?
Okay, so an embedded derivative is basically a feature within an insurance contract whose value moves with some underlying factor, like an interest rate, stock index, or currency rate.
So a contract within a contract, almost.
Sort of, yeah. And under IFRS, the rules are quite strict. If this embedded derivative meets specific criteria and isn't considered closely related to the main insurance part,
Then what?
it has to be separated out, accounted for on its own as a financial instrument at fair value typically.
Okay, strict separation under IFRS if it's not closely related. How about US GAAP?
The documents suggest US GAAP can be different here. Less emphasis on mandatory separation in some cases.
Oh, any examples?
Particularly mentioned are life contingent contracts, where payouts depend on someone being alive.
Yeah.
US GAAP might not force separation as readily there.
So another nuance where the frameworks diverge.
Definitely reflects different views on how integrated these features are with the host insurance contract.
You mentioned the premium allocation approach, PAA, earlier as an IFRS alternative. When is that used?
It's a simplified model allowed under IFRS for certain typically short duration contracts.
Simpler how?
Generally, you recognize the premium received as revenue pretty much straight line over the coverage period.
Okay. And the cost of getting the contract?
Usually expensed right away, unless they are really directly tied to fulfilling the contract itself.
So insurers might use PAA if it's a good enough approximation of the GMM, but, well, easier.
Exactly. Less complex operationally, provided it gives reasonable results for those types of contracts.
Now, both standards seem big on the time value of money. Discounting comes up a lot.
That's right. Both IFRS and US GAAP say you have to consider that $1 today isn't worth the same as $1 in 10 years. So future cash flows used to measure liabilities are typically discounted.
using appropriate discount rates, I assume.
Yes, reflecting current market rates and the characteristics of the specific liabilities.
And didn't you mention IFRS has that explicit risk adjustment on top of discounting?
I did, yes.
Oh.
That's a distinct requirement in IFRS, an extra layer added to the discounted cash flows to compensate for uncertainty.
How does US GAAP handle that uncertainty compensation?
It's generally considered more implicit. The document suggests it's factored into the best estimates of the cash flows themselves, rather than being a separate, explicit add-on like the IFRS risk adjustment.
Interesting difference in presentation, even if the underlying economics are considered.
Exactly. Explicit versus implicit handling of that uncertainty margin.
Okay, nearly there. Let's quickly cover reinsurance insurance for insurers. How's that handled?
Pretty straightforward concept. Insurers manage their own risk by passing some of it to a reinsurer.
And the accounting follows.
Yes, both IFRS and US GAAP have guidance. The key is recognizing an asset for the amounts the original insurer expects to recover from the reinsurer.
Makes sense. You have a liability, but also an asset representing the recovery.
Correct. And just like with primary insurance, if the reinsurance contract doesn't transfer significant insurance risk,
Back to that key concept.
then it's treated as a financial instrument, not reinsurance. Same principle applies.
Okay, so pulling it all together based on these documents, what are maybe 2 or 3 key differences between IFRS and US GAAP that really stand out?
Well, first, that default GMM under IFRS
Correct.
versus the more contract-specific measurement approach in US GAAP, that feels pretty fundamental.
Right, the starting point for measurement. What else?
The disclosure requirements seem notably more extensive under US GAAP in certain areas, especially for short-duration contracts and SEC filers.
More detail demanded there.
And third, maybe those nuances in handling embedded derivatives, the separation criteria, seem stricter under IFRS in some ways.
Yeah, those stood out, but the overall message seems to be.
That the specific terms and characteristics of the actual insurance contract are incredibly important under both sets of standards. The details matter a lot.
It's definitely clear that insurance accounting is complex territory under both IFRS and US GAAP. This has certainly shed light on some core principles, though.
Absolutely. It's a deep topic, and we've really just hit the highlights based on these materials, but hopefully it gives a better feel for the landscape.
It does. And that brings us to a final thought for you, our listener. Thinking about these different ways IFRS and US GAAP recognize and measure insurance liabilities. What impact could these accounting choices have? How might they affect how investors or analysts or anyone, really, looks at and compares the financial health and performance of insurance companies using these different standards around the world? Something to ponder.
A very relevant question indeed.
Thanks for joining us on this deep dive.